Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us on tonight's program. I actually explained to you why I bought more Tyro shares this week, despite the fact that the share price was absolutely clobbered. We've got Marcus Bogdan from Blackmore Capital, and he also runs the Switzer Dividend Growth Fund. On the stocks he's bought because of reporting season, the ones he's added to the fund. We've got Michael Knox on where the Australian dollar is going to go. Really important for people who are investing overseas. We've got Ying Yi and Cheng from Coolabah Capital talking about when interest rates will rise in Australia, how many rate rises we should see. And finally, Paul Rickard of the Switzer Report looks at Appen that reported today, as well as other tech stocks and payment companies. Why are they being smashed? That's the show. So let's kick off with me talking about why I bought Tyro this week. Hi there, I'd like to explain why I bought more Tyro this week, despite the CEO Robbie Cook not being available to come on the show to tell us what in the hell is going on. In case you missed it, the company reported this week, and this has what has actually happened to the share price. Tyro's payments for 5 days is a chart on screen right now. Now, it lost about 30% this week, but the company has been struggling since October last year. Have a look at this next chart. This is Tyro over the past 5 years, but you can see since October, the share price really has tumbled from about $4 down to $1.48. So what's happened? Let's have a look at the tech stock index called the NASDAQ, where the US's famous tech stocks actually live. That's on screen right now. And as you can see, tech stocks have been falling since January. And this doesn't help a company like Tyro, which is not only a payments company, but is also a tech company. You can see there that tech stocks have really copped it. So that's the tech stock sell-off effect. But what about the payments sector? Let's check out the world's most famous payments business, namely PayPal. Now, this was a $380 US stock in August last year and was $268 in October. But now wait for it, it's $100. It's down 63% since October. And guess what? Tyro's down 63%. Afterpay's down 59%, and Zip is off 64%. Do you see a pattern? Payments companies are out of favour. So are tech companies. And that's why the likes of Tyro are being smashed. So the big question is, will it last? Why should we buy these payments companies anyway? Buy if you can wait for a re-rating of payments companies. Buy if you think the fund managers of the world that heavily influence stocks prices will one day say, hey, these good companies that were overpriced, but they now look like they're underpriced. Buy if you think a company like Tyro will benefit from the reopening of the economy, the return to normal life, the arrival of tourists who go to pubs and cafes where Tyro's machines are used. Also buy if you like knowing that Mike Cannon-Brookes owns 13% of this company, but don't take my word, or don't just take the fact that Mike Cannon-Brookes owns a whole chunk of Tyro. Have a look at what all the experts are saying on FN Arena. These are the guys who survey companies all the time. Have a look at the chart that's on screen right now. But don't take my word for it or Mike Cannon-Brookes Holdings to punt on Tyro. Let's just see what the expert analysts think about the company going forward. The consensus average rise for Tyro's share price is, wait for it, 98%. But let's look at the individual calls. You can see this on the table right in front of you. Have a look at that. Morgan's thinks it's going to be an 81% rise. Macquarie, 45% rise. Morgan Stanley, wait for 217%, and Ord Minnett, 102%. Even if these guys are only half right, that's not going to be a bad rise. So a lot of people think Tyro has a future. So it's not just me talking through my hat or through my wallet. And that's part of the reason why I was prepared to have another crack at it, though I do believe it's going to take time for the Tyro share price to improve, that's for sure. So finally, looking at these calls, I'm happy to remain a believer in Tyro as a company. And I will take the tip that Warren Buffett gave all of us, to be greedy when others are fearful. I'm a patient investor who likes to buy good companies when the market beats up on a sector that one day I think will be reloved again. But I do hope this reloving comes sometime this year. I'll keep trying to get the CEO of Tyro, Robbie Cook, for the show ASAP. Stay tuned. Well, we're catching up with Marcus Bogdan, the fund manager of the Switzer Dividend Growth Fund and of Blackmore Capital. Marcus, great to see you.
True to be here, Peter.
This is an exciting time for you, isn't it? Reporting season. Someone like you, it's like grand final time for an AFL supporter.
It's a time of the year where we relish, and the reporting season so far has been better than expected. When we're sitting in early January in the midst of Omicron, I was concerned around the trajectory of earnings. But earnings broadly have been better than expected, and that's been primarily driven by commodities and financials.
But what's really interesting, Marcus, is that this is for the 6 months going from July 1 to December 31. And there was a whole lot of lockdowns in there as well. Then we got an escape, probably over October, November. Then December, Omicron comes. So for companies to report well, that's a very good sign, isn't it?
Extraordinary. And you're right, we've had a lot of false dawns and a lot of false starts. And they have reported, I mean, companies like Endeavour where, 40% of their hotels were in lockdown over a 3-month period in time. But they've generated higher sales revenue, and the mixes there have been better than anticipated across the board.
Okay. This is a little fact that I bet you didn't come across. And I know you pore over financial facts like I do, but this one quite shocked me. Israel is apparently a very good forward indicator for the US economy. Didn't know that.
Right, yeah.
And the December quarter in Israel was a 16% spike in economic growth.
Okay.
And when I read that, I thought, well, I've been saying that in the second half of this year, when we get over Omicron, we're going to see a really big economic rebound.
Yes.
Are you feeling that, provided we don't get another Omicron type challenge to economies, there is going to be a massive economic rebound?
Yeah, there's certainly those challenges that we know that are out there, and obviously there's always that persistence there that another variant can come along. But we're looking at the numbers, the facts that are companies reporting. GDP is stronger than anticipated, employment is stronger, and we've also seen that when we've come out of these lockdowns, there has been a sharp rebound. And there's evidence of that coming. There's also evidence that the supply constraints that we've had in the economy are certainly not getting any worse, and we're seeing fewer issues around Omicron, around absenteeism as well.
Okay, because you're a fun kind of money guy, let me share another really interesting observation I picked up this morning, that this US analyst was saying, because of the virus, we're buying a greater proportion of products compared to services than we do when it's normal. And the classic example is we can't fly overseas, so what did we do? We went to JB Hi-Fi and Harvey Norman and bought stuff.
Yeah.
But once we can fly again, once we can move around our country even again, we'll start buying more services and we'll buy less products, and there could be a whole lot of inventory. And what do stores do when they have too much inventory? They cut prices. So that could be another reason why inflation could come down over the course of this year and next.
Yes, and look, and economic forecasting has been incredibly problematic.
Yeah.
And we talked about this before. 6 months ago in the US, there was no prospect of an interest rate rise in the US in 2022. Today, companies like Goldman Sachs are suggesting there could be between 5 and 7.
Yeah.
So we really just look at the underlying earnings of the companies and what the companies are saying to give us an indication of what's occurring.
All right, so that's the interesting stuff that money type people like you and me like to talk. People watching this want to know, what, as a consequence of this reporting season, what new companies have you added to the fund, and what companies have you added to because you were really impressed with what you saw?
Okay, so we're getting to the back end of reporting season now. There are a number of companies that we've got on our watch list of potential new companies to come into the portfolio, and those companies that we're looking to add to. So far, we haven't made any additions or deletions in the portfolio. We did put NAB in before their result.
Yep.
And that was quite good because that was a result that was better than expected. So,
Are you expecting the banks to keep on doing well?
well, you've got to look at the individual names. I think CBA, which we've got in the portfolio, and NAB are growing above system. And that's another reason why we're confident around the economy, because we're seeing very strong lending growth, very strong deposit growth, and a very benign environment for credit.
Yeah.
But companies like Macquarie, we're keeping a very close eye on, which moves up and down with the market. But I think longer term, as they're pivoting that business toward green infrastructure, I think that there is a long pathway there for them to benefit from that.
And they're also pushing themselves into lending to normal people, aren't they? A lot of their ads are sort of trying to go into it, and they were there many years ago and they kind of got out of it.
Yeah.
So it's just another little string they're adding to
Yes.
their bow. All right, so what about companies that have impressed you that you might be considering adding to the portfolio?
So there's companies that are particularly in insurance or insurance brokers, companies like Steadfast. Seek is another example where it's far more employment.
Yeah.
But they're more growth-orientated companies.
Yeah.
Growth has traded at a very significant premium to the market. But what we're watching now is a compression of those valuations. And so once we believe that those valuations have compressed enough and the underlying
You might
business
seize
model,
upon them.
we might then look to move into those. And so Seek is a good example.
Because
of that.
your fund primarily likes to get great dividend payers, but if you see opportunities for growth, because there's good value at the moment, you will at least get into it for a time and
Yes.
benefit from the
Yes,
growth.
absolutely. And remembering investors' returns.
And CSL's a case in point, isn't it?
And investors' returns in two parts. It's both capital growth and dividend growth. And why earnings are so important is they are a reflection of the dividends. So if earnings are growing, then ultimately you'll see growth in dividends. And we're seeing growth in dividends, which is higher than the inflation rate, which is terrific.
Okay. One last question. I read something brilliant on Monday, which I actually wrote in the Switzer Report. And I made the point that in October or so last year, from my reading of a lot of analysts and talking to people like you, it seemed apparent that three areas were going to do well, and that was financials, miners, and energy. And they've done really well. We've seen BHP go from about 35 up to 45 or whatever. So there's been a nice rebound there. And my argument in the Switch Report on Monday was these will probably still keep doing well, but the gains are going to get smaller and smaller because the big ones have been had. But if you want to get big long-term gains, or big gains, you might have to wait. And so some tech stocks that have been beaten up, eventually, I suspect, will make a comeback.
Yes.
Is there a tech stock that I guess you mentioned Seek, which is a tech stock. Is there a tech stock there that you've considered one day you might add to the fund to get some growth?
Yeah, there are a couple. One is Xero, which is the digital accounting group.
Yep.
We've previously had them in the fund, and we sold them because the valuation
Went up.
was excessive.
Yeah.
And so they got to $150. Earlier this week they were back at 98. So that is one that we like because it's a subscription business.
Yeah.
It's small businesses are regulated to put their tax returns in digitally, and they're a global business as well. So that is one also. But I'd also point to the fact that there have been big sectors in the economy which have been laggards in the benchmark.
I know you're going to say healthcare, aren't you?
Well, healthcare is one, and I'm not going to repeat that one. But consumer staples has been one which has really struggled, and obviously Coles and Woolworths we've got in the portfolio. They've delivered results which were better than expected, and they are now starting to see some of the cost pressures ease, and then they're also a beneficiary of higher inflation as well.
Okay, thanks, Marcus.
Terrific, thanks Peter.
That's Marcus Bogdan, a guy who looks at stocks 24/7. He's got nothing else in his life, the poor guy, but still, it's worth talking to. My next guest is Michael Knox, Chief Economist at Morgans, and I always like to catch up with Michael to see where he thinks the dollar's going, where interest rates might be heading, and will we see a really big economic rebound this year? Michael, great to see you.
Good to see you, Peter.
Okay, let's not muck around with pleasantries. Let's get straight to the really important matters. The Aussie, the Aussie dollar. What's your forecast for 2022 and the Aussie dollar?
Well, we're going through a US dollar bubble. We have a model of the Aussie dollar, which is the standard model. It's both prices and interest rates, relative interest rates. And like all models like that, the commodity prices have gone up currently in US dollar terms. The RBA index of export prices is 54% higher than it was for the average of 19 and 20. But the Aussie dollar is treading water or even drifting down. And the Aussie dollar extremely undervalued. 3 standard areas undervalued in terms. Why is that happening? Well, I think there's 2 things that seem to be happening at the moment. Firstly, that if I take notice of people like Raghu Rajan, who was the chief economist of the IMF, who forecast a financial crisis and then became the governor of the Reserve Bank of India, and people like Mervyn King, who was the person who began QE as governor of the Royal Bank of England. Both of those people have said recently that real yields on US Treasury bonds are far too low, and that they think that is an extraordinary event. That given where inflation is, what's interesting is that US bond yields have yet to respond. And that suggests to me that there has been aggressive buying of US Treasuries, and that has got to the point where it is a bubble in US Treasuries, or generated a bubble in the US dollar. And so you've got this exceptionally high value of the US dollar at a time when increasing inflation suggests that this could be put this high dollar at risk. The person who's done the best analysis of this phenomenon is Ricardo Reis. Right? Ricardo Reis is a European economist who's done a lot of work in the US, but is now back at the London School of Economics, which is where he did his first degree. And he's done a couple of presentations recently. One was called "Is an inflation disaster around the corner?" When he did that on the 22nd of October with the Paris School of Economics. And he's done another one on February the 17th, 22, with Princeton in the US. And this is with a person called Mark. And in both of these, what he says is that inflationary expectations of where inflation is going to be over the next 5 years in US Treasury bonds is increasing, but has not, and is certainly increasing relative to the inflationary expectations for Euro area bonds. He expects that this will get to a point where there will be a sell-off in US Treasuries relative to Euro area bonds, and that will generate a fall in the US dollar. But we've yet to get to that point. So the short answer of this is that there's a bubble in the US dollar because the market is buying US Treasury bonds on yield, but are currently not taking enough attention of the inflationary risk. As they become increasingly aware of the long-term inflationary risk, what will happen is they'll start selling those US Treasuries and the US dollar will go down. But until that occurs, what we've got is a bubble in the US dollar, right. Which is not just making the Australian dollar too low, it's making everything else too low, relative to the US dollar.
Okay, so let's move. So therefore, eventually you think the US dollar falls and the A dollar will rise. Is that just a yes or no?
Yeah. Yes.
Okay.
Yes.
So
But it takes some time. It will take
Yeah.
some time to work through this process.
yeah. So if we get a very big economic rebound in the second half of this year, on the basis that there are no more Omicrons, we learn how to live with the virus, and there is a big economic rebound, what do you think that will do to the A dollar versus the US dollar?
Well, I think there's two different things. I think you've got the real level of activity, and activity is very strong. But US growth to be about 4.5% or better in the second half of the year, and Australian growth the same.
Yeah.
After all, we've got the highest terms of trade in Australia now since the previous resources boom. And that generates high growth in incomes in Australia, high growth in demand. And we've got this, as we say, that the Aussie dollar has yet to respond to the extremely high commodity prices. So this is generating high levels of income in Australia. So this is one of the best times in our lifetime for the Australian economy.
Yeah.
And for profits of Australian companies.
So Noxie, let's go to the calls out there that the US will raise interest rates. Like some people think there'll be 10 rises this year. I don't know how you get 10 rises this year, but how many rises do you think the Fed's going to embrace this year? How many interest rate rises?
Well, they've also said they're going to do two things. They're going to start reducing the size of the balance sheet, and they're going to increase rates. And they haven't told us yet what the reduction in the balance sheet is, because they haven't worked it out yet. But I think what's going to be happening over the next 3 years is that they're going to be raising rates and reducing the size of the balance sheet at the same time.
Yeah.
And I think the result of that is that the number of rate hikes that's required will be less than the market necessarily believes. They've said that they'll get rates up to 250 basis points after 3 years. There's 10 rate hikes over 3 years, and that's what we think they'll do.
Yeah.
But a lot of tightening will happen because they're running down the balance sheet at the same time.
Okay.
So that's the reason for the limited upside in
which makes perfect sense. What about in Australia? When do you think good old Dr. Phil will start raising interest rates?
Oh, he hates being called Dr. Phil because Dr. Phil's somebody on TV.
Yeah, I love Dr. Phil.
Mr. Philip Lowe, PhD.
No, I love both Dr. Phils. But go on.
Yes. Well, I think Mr. Philip Lowe, PhD, has pointed out that inflation in Australia is half the size of the US. And the reason I think that that's happened is because our budget deficit was half the size of it. So that's reasonable. And therefore, he thinks rate increases will be lower than in the US. So I think he's going to watch the Fed hike rates at least twice before he decides it's time for him to start putting up rates. So I don't expect any increase in the Australian cash rate before the end of the year. And given that, as I say, inflation is half as high here as it is there, then we go up, then rates will go up more slowly. But of course, because inflation is lower in Australia, the Australian dollar is actually cheaper because of this purchasing power parity thing.
Yeah.
So that still supports. You don't need the same number of rate hikes to support the same increase in the level of the Australian dollar.
Yeah.
Because our inflation is low.
All right, mate. Well, fantastic. Great to talk to you. And I take my hat off to you for your defence of Dr. Phil Lowe, PhD. But he'll always
Mr. Philip Lowe, PhD.
But he'll always be Dr. Phil to me. Great to talk to you, mate. We'll catch up in a month's time. Cheers.
Great to talk to you.
Cheers, mate. We're catching up now with Ying Yian Chen from Coolabah Capital, and the subject is her favourite. It's what she sleeps and thinks about 24/7, interest rates. Ying Yi, how are you?
Hi, Peter. Thank you for the introduction.
Well, it makes you an unbelievably exciting person to be continually preoccupied with something that's really important to the world of money, interest rates.
True. It is very, very important and topical at the moment.
Yeah, without a doubt. So I've got a whole pile of, I think, difficult questions, but people would be curious about what your business is thinking about, because Coolabah specialises in bonds, and bonds is driven by interest rates and what might happen. So let's just try and get the latest feeling from you guys. So the first question I've got is, how many rate rises are you guys expecting in the US this year?
Yeah, I think, look, there's currently around 7 sort of rate hikes priced in. I think that's fair. That would imply that they would need to go at pretty much every meeting live. So I think that's realistic. Obviously, you know, our views around inflation are that the Fed is already behind the curve, so arguably they probably should be doing more. Whether they do, you know, more than 7 hikes this year is obviously questionable. The markets obviously, you know, jump to that sort of view quite quickly. I mean, look, probably think that they should do, you know, 10 rate hikes if anything. But, you know, the question of should and whether they will is obviously a very different one.
This is the one question I didn't suggest I might ask you, but you're so smart, you can handle it anyway. A potential very difficult situation, Ukraine, Russia and NATO allies, could that make the Fed hesitate to put another negative in there for financial markets?
Yeah, that's definitely a legitimate sort of a question, but I think the reasons for, you know, taking monetary policy away from 0% interest rates and super loose policy is related to inflation, and there's definitely an inflation problem. So the more that they delay hiking rates, the more, you know, of an inflation issue that they are creating down the track, and, you know, the harder it is to stay on track of. You know, 0% interest rates is obviously the lowest as you can get, obviously without going to negative rates. But even if they were to hike to 0.25%, 0.5%, you know, 1%, that's still expansionary.
Yeah. Okay, let's go to the really hard question. Will the first rate rise, which we pretty well know it's going to be March, so the upcoming month, but will it be 0.25%, 0.5%, or as James Bullard, the St. Louis president of the Fed, 1%? What's your best guess?
Yeah, we're probably of the view that it's going to be 0.25%. I mean, 0.5% is definitely a risk, but if you look at the rhetoric coming out of other Fed members, it would point towards more like 0.25%.
Yeah, okay, me too, I agree with that. Well, let's go to our first rate rise here. What's Coolabah's best guess on when we'll see rates go up?
Yeah, our core expectation is that we'll see the first rate hike in August. Obviously, there are, you know, people of, you know, different sort of views and camps. You know, some people are looking for May. Our view around the August rate hike is more so a couple-fold. The RBA is firstly, you know, quite keen on seeing, you know, several inflation prints or CPI prints before they make a decision around hiking interest rates. And then secondly, also, I think from a political perspective, you know, regardless of whether Labor or Liberal do come into power, hiking in May may be, you know, a bit too soon from a political perspective, even if the RBA is, you know, deemed to be independent. It probably wouldn't look good politically.
Okay, let's go to how many rate rises are you guys expecting in Australia this year?
Yeah, good question. Probably just about two rate hikes this year out of the RBA. We have a very different inflation profile versus the US. So obviously in the US, core inflation is running, or core PCE, I should say, which is the Fed's preferred measure, is running around 4.7%. Wage inflation is around 4.7% as well. Whereas here, sure, we're like, bit over 2%, which is within that sort of target range. And at the same time, wage inflation, which we'll get numbers out, this week as well, that is running a bit over 2% as well. So definitely different profile, and they're obviously not in as much of a hurry versus the US.
Have you thought about why US inflation is higher than Australian inflation?
Well, we were already behind the curve in terms of inflation, I should say, not the RBA necessarily. So the RBA, even heading into the pandemic, was already undershooting its, inflation objectives in terms of, targeting 2 to 3% inflation. So we're coming from a very different base to begin with. Obviously, over in the US, there's tightness in the labour market, whereas here, when we get, we do have tightness in the labour market here as well, but, they definitely haven't had closed borders in that respect. And so we are expecting to open our borders, as you know, and therefore that influx of, immigrants and also international students will sort of help to moderate a bit of that wage inflation pressure.
I've only just thought about this when I was listening to your, as usual, brilliant answer. And I'm wondering whether JobKeeper has taken the pressure off wage demands, because for lots of workers, their wages didn't change over the course of the pandemic. But in the US, where the labour market is far more flexible, they may have actually seen a lot of wage falls, and now they're playing catch up.
Yeah, but they did also have stimulus checks, and JobKeeper obviously is not around anymore. But yes, initially JobKeeper was definitely very attractive. I mean, I definitely had heard of anecdotes whereby people were getting paid more on JobKeeper than they traditionally would be in their normal job, because they worked casually or they worked part-time, for example. So it definitely was a good measure from the government in terms of an immediate blanket policy response, but it was very blunt, and it was far-reaching in that respect. In the US, there was obviously stimulus checks as well, people going on unemployment benefits, but you also had people come out of the labour force in the US as well, just disenfranchised by, like COVID, and moving out of, certain sort of industries around, hospitality, etc., just because of the dangers associated with working in that industry given the pandemic. So, encouraging those people to come back is obviously, there are people that are coming back, but then there are at the same time that people have just left, permanently, and maybe working in what they call the gig economy now.
Yeah. It's a great question. Could be a great PhD paper, that one. Finally, let's go to inflation. Do you think inflation in both the US and Australia will eventually prove to be temporary, or though it might take longer for it to start to dissipate and fall? Or do you fear that there may well be a number of years of rising inflation?
Yeah, well, this is why central banks need to nip it in the bud, right? Because inflation expectations have been moving higher. So if you look at the US, the University of Michigan surveys have inflation pointing to, inflation expectations over the next sort of 12 months, quite high. I think it's around, a bit over 6%. If we look at the New York Fed inflation expectations, they're around, 4-point-something% over the next 12 months. Over the next 3 years, people are expecting, 3-point-something%. So, as we know, when if we're expecting something, we're going to, change our behavior in line with that expectation. So if people are behaving in a way such that they expect higher prices in the future, then, that can be self-fulfilling. And that is a concern. So unless central banks, depending on, their hiking profile and whether they nip this inflation problem, sooner rather than later, will have a huge impact on these inflation expectations. So that's hugely important, and that will impact, how far reaching or how long this inflation will last. At the same time, look, our view is that it isn't transitory. Sure, there are supply chain constraints, but, in some ways you could argue that everything that, could affect inflation or that is bad with respect to, price profile has already happened. But there could be, potential issues down the line. So we could have a wage price spiral that could perpetuate things. So things start costing more, so I demand higher wages then feed through to the cost of goods and services, and then we get that wage price spiral, which is obviously not desirable, hence why I mentioned that central banks need to nip it in the bud. And then secondly, you also have the risk of other variants which could affect the supply chain down the track as well.
Yeah, good point. One final one, and this is purely a vested interest question. You guys manage the Switzer High Yield Fund, but it's on a floating rate. So rising interest rates should be good for that fund?
Yeah, it's beneficial because in a floating rate fund, your interest rate is not fixed, so because it's floating. Yeah. So when, for example, if you have invested in a fixed rate fund, usually you've fixed your rate at a lower rate if interest rates are moving higher. So you don't benefit from that high yield or that high income that comes from the bond. As interest rates move higher, that benefits floating rate, funds like the Switzer High Yield Fund, because the underlying coupon or the income that's coming from the investments within that fund are going to be higher.
Yeah, great. I'm glad that Chris talked me into it. Good on him. Okay, thanks for joining us, Ying Yi.
Thank you, Peter.
And that's Ying Yi and Chen from Coolabah Capital. Well, I'm catching up with Paul Rickard from the Switzer Report just to see what he thought about Appen's report and tech stocks and payments companies that really have copped it this week, Paul.
Well, Appen certainly copped it, Peter, and I guess probably the main reason that Appen copped it is it declined to provide short-term guidance. It had previously
So we're
provided
still guessing with Appen going forward.
We're still guessing with Appen, and it provided guidance about some targets about FY26, where it's going to double revenues.
Yeah.
That's 5 years away, right? What we want to know is what's going to happen in the next couple of years, and it sort of withdrew guidance, didn't like that. And so always, when you've been providing numbers and forecasts and you take it away, the market is immediately suspicious.
Yeah.
Right? What aren't they telling us? Costs are up a little bit. They said costs would be up in the next half compared to this half as it invests. Your revenue growth was okay, but it's nothing shooting the lights out. And I think there's a lot of people, you, me, most analysts have been a believer in this company.
Yeah.
And eventually it just becomes too much. And I think today you saw was a final
I guess a lot of us have thought that once the worst of this coronavirus is out of the way, this is a company that would benefit. But I guess the fact that it's lagged on could be one part of the problem. It's gone longer than we were expected. But there's still, this company's not giving me a good feeling, Paul. And, I've got a small investment in it, and I'm thinking to myself, am I going to keep sticking by it? I don't know.
Yeah, well, I mean, I guess, we're all sort of believers in artificial intelligence.
Yeah,
we believe in
go.
this sort of company. I mean, this company actually makes money. It is profitable. It produces $1. It pays a dividend. But, for a company that was in its 40s, I think it got to about $44, $45. To see it down today around $6.50, is a bit of a disgrace. And I think it's sort of the capitulation. Where it goes to now, there's got to be some value there somewhere, right?
Okay.
But
this,
I think we're all hoping that it bottomed before today, and we saw it didn't, and
we've ended up on our bottoms.
We're ended up on our bottoms, Pete.
Let's go to finally payments companies. They've really copped it. Tyro's copped it. Zip's copped it. Afterpay. All these companies have been smashed. Paul, what do you think's behind it? Is there something structurally wrong with them, or is it something that is just big fund managers have got out of this space and they're chasing other sectors.
No, look, I don't think there's anything fundamentally wrong, Peter. I mean, when you say you've copped it, this is a global trend, right?
Yeah.
And you look at the payment leaders, your so-called PayPals, your what's now Square, what is now Block,
Yeah,
right? Which
yeah.
Put up Afterpay. These companies are both down 65% in the last 12 months. And so we have seen a de-rating of the whole sector. Every payments company's been hit. Put it down to it, I think it all got hyped up a bit too much in the first place. So we
Yeah.
always warn about the hype cycle. You know, you never know how long it's going to go.
And there's more competitors too, aren't
More
there?
competitors.
Yeah.
I think it'll come back, but it's sort of, we've seen a global derating. It then got caught up in the tech sell-off. This actually started more like back in about November.
Yeah, October, November,
It's got caught up in the tech sell-off, and it's just been, I think, something that the Australian companies aren't strong enough to withstand those international
So it's going to be a
trends.
matter of faith, Paul, but you do suspect that they eventually will make a bit of a comeback.
I think there'll be a comeback, but I don't think you suddenly go from we don't love, sort of in love, you go to out of love, and it's hard to get back in love again. So it's going to have to do some work, Pete.
Yeah, okay.
But you can't. Whereas you can pick the candidates in Australia, you've got to be look at what's going on overseas. And unfortunately, in many cases, we just follow the leader.
Exactly right. That's Paul Rickard of the Swiss Report. And that's the show for this week. Thanks for joining us. Don't forget, if you want more insights into the sort of stocks you should be thinking about buying, subscribe to the Switzer Report, switzerreport.com.au. See you on Monday night.